Welcome back to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate Radio is designed to build the Washington, D.C. Metro's market by giving you good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. So before the break, we were talking about the foreclosure rise in August. And they actually made mention in the article that it was good news that the bank repossessions have been falling. And really, I don't really think that that's good news, because it's just there's just a hangover effect going on of the amount of properties that have just yet to be, to start the foreclosure process. There's a lot more out there that have come, and just because, the number of repossessions are falling doesn't mean that the foreclosures aren't actually rising. It's just getting, as we've been saying for months, kicking the can down the road. Wouldn't you agree with that, Louis?
100%, because eventually those homes will enter into the foreclosure process, the ones that are in the so-called shadow inventory. It just means there's a lull in the current foreclosures.
And it's interesting, too, because I've heard, obviously we have the deal that that behind the closed doors deal of Fannie Mae buying $500 billion worth of non-performing notes from Bank of America. These are the type of things that really push the foreclosure process down the road 2 and 3 years, because then they have to take ownership of these loans and start servicing them. Then they have to start serving out the notice of defaults and the whatever process it is in each state, whether it's judicial or non-judicial. And I saw another article that was interesting. It was talking about Freddie Mac will sell their portfolios of non-performing in bulk, but with no discounts. They're not willing to give the 20, 30 cents on a dollar. And I just think that's kind of funny. Who's going to buy a non-performing portfolio that's not at least discounted down to, something well below 50 cents?
See, this is all prolonging the housing
I know.
we have. You need to liquidate the debt, not immediately, but as soon as you can, and go through the process. It is longer to liquidate homeowners because you have to go through the foreclosure process, but it can be done. But it shouldn't take 2, 3, 5, 7 years. If that happens, you're going to have this problem in the real estate market for that amount of time.
And it seems like that's exactly what's going to happen, because with the Fed trying to keep rates low for an extended period of time, I think it's really trying to protect the profitability of the banks, because if they
because if interest rates rise, they're in a lot of trouble.
A ton of trouble. And when interest rates rise, then we have a problem with home values going back in the other direction, more than likely.
And interest rates rise, the U.S. government's in a lot of trouble too, because then their cost of servicing the debt goes into the trillions.
Yeah, it was interesting in the end of the article. It was,
and that's one of the reasons why they want to move now the short-term, this Operation Twist that they'll probably announce this coming week, to move the short-term securities into the long-term, not just to keep the interest rates low long-term, but also to get that short-term money out of the threat of those interest rates rising.
Absolutely. Those short-term yields, what they're actually paying investors is next to nothing at this point.
Well, because what the U.S. government essentially holds is an arm.
Yep.
If it resets it on at the short end of the curve, they're in a lot of trouble. So they have to get that out to the 10-year.
Yeah, and it's going to be interesting to see if Operation Twist actually. I'm assuming it is going to happen, but the Fed meeting this week will indicate that, and we'll touch base with that next week.
And you'll hear the words unexpected. We thought the economy would be better by now, and that'll be their cover to do it.
Slower than expected growth, as usual. I mean,
slower than expected job growth.
Right. Yeah, the standard stock answers that come out of Fed Chair Bernanke's mouth. It looked like, surprisingly, the top 3 states for foreclosures is the same: Nevada, California, and Arizona. Nevada has had the nation's highest foreclosure rate for more than 4.5 years now. Let's see, the state saw default notices increase by 31%. 1 in every 118 Nevada homes received a foreclosure filing in August, which is incredible. That's absolutely incredible. California came in second with 1 in every 226 homes in foreclosure, and Arizona with 1 in every 248 homes was third. However, we've discussed a couple times on this show that buying a home in these states could be a great potential opportunity for an investment property.
It could be, but just to point out, in the HomeGain third quarter survey, Arizona homeowners, 62% of them think home prices will decrease, and in Nevada, 53% of them think they will decrease.
Yeah, that's crazy.
That's the homeowner. Now, it does not translate over to the real estate agents. They are not in the top 10 of states where real estate agents think home prices will decrease. In fact, the number one state where real estate agents think home prices will increase is Arizona, with 33% predicting an increase there.
Yeah, and I think
But 62% of homeowners think they'll decrease, and I think that's just because they're fully aware of how their homes prices have been hammered in the last couple of years.
right, yeah, and for the people that are currently in homes and unable to get out of them, really can't be any optimism. But for people that don't own a home yet, we're renting and looking to buy their first home, and they're looking at maybe $100,000 home, it's a great opportunity for them.
Well, that's what the real estate agents think in Arizona, because they're in the market every day, whereas the Arizona current homeowner is in their living nightmare every day.
Absolutely. Yeah, that's very interesting, and I think that the home prices, when you're talking around $100,000, I was talking to actually last week to an agent that's out in Arizona, and he was saying, yeah, the rent is going to be more than what you'd pay on a mortgage out here. So he says for most people it makes complete sense if they have obviously the employment history and everything to back that up.
And you also have the baby boomers retiring, and they're generally going to want to go to somewhere where it's warmer. They don't have to shovel snow. So you're probably not going to see Detroit-style prices.
Yep. One of the things that prevents a lot of people from purchasing homes, Lewis, is credit card debts, which is dragging their credit score down. Did you guys know that 40% of your credit score is based on how you use credit cards, and that you need to have at least 3 open credit cards at all times, but not more than 3? If you ever go over 30% of your credit limit, your score will go down as much as 100 points. Now, you're saying to yourself, 100 points, that's a ton. I mean, especially if you're in just the average category of credit score, 680, maybe instead of having a 680, you have a 580, which then prices you out of not being able to obtain a home loan. That's huge. So paying down a credit card will definitely help your credit score, but not much unless it is a substantial payment and it brings it below the 30% of whatever your high credit limit is. And that's a huge differentiation. I think a lot of people say, well, if I just pay it to 50%, then my score will come up. That's not necessarily the case. They really use 30% of the high credit limit as the gauge there. So it is important that you have that understanding. You talk to professionals that can look at your economy and where you're at today and be able to plan for you, whether you're planning on buying in the next 2, 6, 12 months, 24 months. You need to start working on that today.
Hey, Ryan, here's a quick tip that I found that some people are doing. You can borrow money on you mentioned the 401k plan. There's some complications there. But you can also borrow money on your margin account and your stock account.
Stock loans.
Dangerous.
Yep.
But those loans are at a lower rate than your credit card.
Yep.
You can use the money there to pay off your credit card.
Absolutely. And you know what? That you bring up another good point too, Lewis, because we've discussed in the past a lot of people that are like contemplating, okay, what do I do with my property? I'm upside down. I want to take advantage of the low interest rates. If you do have a margin account, stock account, 401k, wherever you're able to borrow, and the interest might be somewhere, I don't know, let's just call it between 3 and 5%, you can refinance your existing loan or loans if you have investment properties, second homes, and you want to pay down to maybe an 80% loan to value so you can get the going rates now. It makes sense to do that.
Well, the risk though with the margin account is if the stocks go down in value and you get a margin call, you end up selling most of your stocks at a significant loss.
Well, actually there are other stock loans, Lewis, that are out there that will actually they basically just say that wherever you're at now, they'll only lend basically up to 70% of that account, and you can't trade those stocks while you have the loan out against them.
You can't trade them, but you can't prevent them from going down, though.
No, correct. But these are unsecured loans. There's actually a company that I'm familiar with because I've done a couple of them that they're unsecured, don't go in your credit report. So that is a viable option. I'm glad you brought that up. We're coming up on the end of our show, but like I said, the big takeaway: pay down your credit cards 30% of your high credit balance. And if you have more than one credit card, always pay the highest interest rate first. Some people think that you can just take and pay $100 extra on each card. I would take that $300 and put it on the highest interest rate card to pay that off the fastest, and that way you could probably get out of debt in somewhere between 7 to 10 years of all your credit cards if you take that approach. Lewis, I want to thank you again for coming on today. For any of the listeners out there who want to check out the HomeGain survey, please check out homegain.com today. You can get the full results on there, and he will have the state results released sometime this week. Appreciate you coming on, Lewis, and we'll have you on again next week.
Thanks for having me, Ryan. See you then.
Thanks, guys, for listening in to Real Estate Radio, where we talk about the Washington, D.C. Metro's real estate and credit markets. If you guys ever have any questions, concerns, whether it's credit-related, finance, real estate, We're here to help you. 877-245-2030. That's 877-245-2030. Or you can reach out to me via the web at realestateradio.dcmetro.com. That's realestateradio.dcmetro.com. We'll be back again next week, next Monday from 2 to 3 p.m. right here on 1580 AM, The Big Talker. I want to thank you guys for listening in. Talk to you next week.